how diversification works for you, the investor. Hello and welcome to yet another episode of BSC's Investor Education Awareness Series. I'm Siddharth Zarabi, and today I'll tell you more about diversification. Diversification may sound complicated, but it actually holds a very simple meaning. For example, if you held just one investment or invested all your money in the shares of just one company and that company performs poorly, you stand the risk of losing all your capital. But if you have a diversified portfolio, which means a variety of different investments, you are less likely to experience any significant loss. Why is this? Well, this is because all various instruments are not likely to perform poorly all at the same time. So the returns on the investments that are doing well will help you to balance out the losses on those investments that are not performing well. Every financial expert recommends that you never, and I repeat, never put all your eggs in one basket. Golden rule of investing. And this is exactly what the concept of diversification means and implies. If you are looking to achieve a diversified portfolio in the stock market, consider exchange traded funds, commodities, bonds, and even index funds. At the end of the day, you basically have to ensure that you have a manageable portfolio and keep your portfolio optimized and keep adding to your investments regularly. For example, if you have 10,000 rupees to invest, use the rupee cost averaging method. Now, what does that mean? Well, this is essentially a strategy that can help you to smooth out highs and lows of market volatility. Through rupee cost averaging, you invest money regularly in a portfolio of securities. This strategy can help you purchase more shares when stock prices are low and fewer when stock prices go high. Investing in the stock market can be exciting if you adopt a disciplined approach, use the rupee cost averaging strategy and method, and have a well-diversified portfolio. You could find investment rewarding even in below market phases. We hope you have enjoyed this quick and informative episode on the importance of diversification. And as I end today's episode, I leave you once again with more expert advice. Take a look.
Diversification means spreading your risk across multiple assets, multiple asset classes, multiple shares, multiple stocks, whatever. So what diversification does is that what it does is when there are two things which are very unrelated to each other, they are uncorrelated. I give you the example of an ice cream maker and an umbrella maker, right? Their businesses are totally uncorrelated because one sells in the hot summer, one sells in the cooler monsoon time. So what happens in the financial theory is that when you are taking on risk to get reward, right? Concentration means you choose one or two items and say that I bet that this will do well in the time frame in my mind. You know, various investors have 1 year, 2 years, 5 years, 10 years, 15 years in their mind. And they are taking the chance that that will do well. But as you know, economies and markets go through cycles. There are good times and bad times, as well as there are times like the COVID, which are called black swan events, which come suddenly and distort the normal working life. So in such situations, it would be nice to have a backup plan. So diversification is nothing but a plan B. A plan B that if what we've chosen to do well is not doing so well, is there something else which is doing well, which I can? Now, when you look at over a medium-term time frame, you can't predict which will do well. Like in the stock market, in dealing with shares, you have the automobile sector, you have the financial sector, you have the cement sector, you have the building material sector, you have the construction. So you have a plethora of industries, all of which are differently affected by various things, such as international economic events, crude price, and you have a lot of imponderables. So instead of just going and saying that I have an astrology package with me which can exactly tell me which company will do well in what time frame. You instead say that I will hedge my bets, spread my risks over a large number of items so that at any given point in time, any one thing going bad is not going to damage my overall portfolio returns too much. So the concept of diversification is to spread over diverse assets. It's the actual opposite of the word concentration, and hence in financial theory, what years of study has found that anywhere between 20 to 50 items, there may be stocks, there may be asset classes, helps you maximize the benefit. What is the benefit of diversification? Reducing risk. But whenever you reduce risk, you lose a little bit of reward. So what diversification does, it chooses the optimum level where you reduce your risk substantially, but you do not give up an equal amount of reward. That is, when you reward by the unit of risk, that is reward per unit of risk you take, diversification helps you get an optimal thing where you can give up some amount of the risk, but without giving up an equal amount of reward. So when you look at the fact that the stock market is a risky place to be in, because economies and markets are always carrying some risk with them, diversification makes sense because as a retail investor, you may be stung by two emotions, greed and fear. And what happens, greed comes in when the market's doing very well, and fear comes in when the market's doing very badly. So the opposite would be the need for your investment. When everybody is fearful is when you should be buying because you're getting things cheap. So diversification helps you to balance this fear and greed by taking an appropriate amount of diverse assets into your portfolio. Mutual funds typically use diversification as one of those tools to enhance your risk-reward equation.